Good morning. I'm Tim Nyland, and today we are discussing the Q2 2021 membership changes, along with my observations related to the earnings certain family of equity model portfolios. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. Note that there is no slide deck for today's webinar. I'm simply going to use the Zacks research system in real time and walk you through the charts. Let's go ahead and get started. I want to go ahead and start with the standard industrial portfolio. And keep in mind that this is the portfolio that I prefer to use as the pulse of the U.S. industrial economy, because it removes those sectors that are not present in the earnings certain family of equity model portfolios. So you won't find any utility stocks in here. You won't find any precious metal names, commodity names, any sort of financials, real estate, insurance companies, anything like that. So keep in mind too that the Zacks standard industrial portfolio that you see on the screen, this is the main model that feeds the entire methodology that ultimately leads into the earnings certain family. And that's why those sectors and industries are not present in this particular model portfolio. And changes for Q2 2021 to the standard industrial portfolio, I went ahead and replaced FLIR Systems with Teledyne. I replaced Varian Medical with Amazon, and I replaced Cooper Tire with MGM Resorts. And many of you might ask, well, why Amazon? Why now? And the issue with Amazon historically has just been its extreme valuation. And as of third quarter last year, Amazon's valuations have obviously been contracting along with its earnings growth at the same time compounding. And it's now, I feel, a good time to go ahead and put it in the industrial portfolio, simply from the perspective of that its valuations are no longer going to have a massive skew effect to the larger analysis that I like to do with these proxies. So Amazon is in, and Varian Medical is obviously out. And keep in mind that we do split the standard industrial portfolio into an even 200 stocks, and we split that between growth names. So I'll pull up the growth portfolio right now, and cyclical names. And what I want everyone to note here is that the growth portfolio of 200 stocks remains absolutely rock solid, 21% forecast growth from an aggregate perspective, to 13% growth in 2022 to 13% forecast growth in 23. You can see a little bit of a topping off here in this portfolio, and we've seen that obviously with the remainder of the growth stocks, especially the mega cap tilts. In the cyclical portfolio, specifically, it was Cooper Tire that was replaced with MGM Resorts. We already have Wynn in here, so it was time to add MGM as well. So what I want to do here is probably one of the larger takeaways from today's webinar is what's going on in the cyclical space. And a couple webinars ago, I kind of gave everybody a little bit of a warning that I'm starting to see signs that the cyclical rotation was topping out, and growth stocks are going to be coming, back into favor. And now we're getting our first evidence, obviously, that this is really taking place. You can see that cyclical stocks now have literally started topping out. We've seen a couple attempts at a top out here, and I think this might be the last one before this growth just starts to no longer be parabolic like it's been literally since the bottom of COVID. And this group of stocks, this group of 200 earnings unstable names, or what everybody likes to call value stocks or cyclical stocks, this is the group to watch. And the reason for that is that the forecast growth is now expected to normalize. And this, you'll hear me talk about this concept of normalization over and over again. It's so important. We don't value these stocks at 81% growth stocks. We value this group more in line with overall market trend. And you can see that this growth falls down to 8% in 2022 and then pops back up to about 12% in 2023. So we want to keep an eye on that. We also want to keep an eye on the forward multiples. Remember that a lot of these underlying stocks in the cyclical portfolio, they're trading at current valuations that are based on earnings 2 to 3 years forward. So we want to make sure that this group, in fact, holds up while these earnings are delivered. We don't want to see a market crash here in the cyclical space. So hopefully we get a valuation catch up and these names get caught up. And again, I mentioned the cyclical portfolio. We went ahead and replaced Cooper Tire with MGM Resorts. Specifically, the growth portfolio that I'd mentioned before, let me just mention specific membership changes here again. I replaced FLIR Systems with Teledyne, Varian Medical I replaced with Amazon. When we go down to the 75 most earnings stable names out of the growth portfolio, we get into the earnings certain portfolio, which I have here. Keep in mind, we're doing this in real time. And there were no changes at all this quarter to any of the earnings certain family of core equity model portfolios. And this is obviously something that's not necessarily out of the norm. I've gone many, many quarters in a row with no changes to these groups. It's a little bit odd right now because we're coming off of this COVID event. And over the last year, I have been making several changes. I've had stocks that have been on watch for many, many quarters, if not a year or more. And I've taken COVID as an opportunity to go ahead and replace some of those names. And so this quarter, I'm pleased to announce that there are no changes. There's really no need to change, and we don't make change to these portfolios for the sake of making change. And that's one of the real keys to keeping the turnover low. I only make changes to these portfolios when I see fit. And just to give everyone an example of what this looks like, I'm going to go ahead and split this composite down into its members and just talk to you about some of the patience that I've had in the past with companies that have lost their way from time to time in terms of earnings growth or otherwise. And Walmart was a prime example of this. They struggled for a couple of years back here, 16, 17, before they finally started recovering in 18. But you can see they've got a nice growth trajectory now. And Walmart has just always been just one of those superior, rock solid, earnings stable names. So, we tend to give these types of companies a pass. The other companies that we give a pass to, and I'll go ahead and just use my list control so you can see how this works, are companies like TJ Maxx. Obviously, these companies have just been stellar performers. Their earnings, through recessions have just gone through unscathed. But giving them a one-time pass for COVID, obviously they've got a lot of working through this earnings trough to do yet. But we can see this throughout the portfolio itself, and it's okay. Obviously, valuations have already reflected the recovery. Same thing with Starbucks. I can go on and on. There's literally 45 names in the earnings certain portfolio that experienced some sort of earnings trough due to the COVID crisis, and that's what caused this little blip right here, this little flattening of that earnings trend. So we have a solution for that. It's called the Admiral Portfolio. We'll talk about that in just a minute. But before we jump to that, I want to just share my thoughts on what's going on with the EPS revision trend, which is pretty solid. Estimates even after July, as of July of 2021, just rock solid. Look at the forecast growth here, up 13.4% from July of 2020. So from a year ago, continuing to be revised higher, which is just tremendous. This is what we like to see and what we expect constantly from the earnings certain portfolio. Okay. And that's what we're seeing. So this is a good thing. So let's go ahead and talk about the Admiral Portfolio. And remember, I mentioned the companies that we're giving a pass to. Before we do that, let me go ahead and split this into its membership one more time. I do have one company that I ended up putting on watch this quarter. I've been keeping an eye on this thing for a year, and it's officially been put on watch now, and it's C.H. Robinson. Global logistics company, just a tremendous company, tremendous management team. And we started getting into a little bit of earnings variability, I noticed here in 18 and 19. And then obviously COVID's kind of taken its toll. I'm not really going to put a lot of emphasis on this FY3 forecast because I've only got one analyst here making a forecast. So I'm really just going to see what happens to this earnings trajectory and keep a tight pulse on C.H. Robinson. But it's one of our nice higher yielding and higher growth type companies. So we're going to give C.H. Robinson a pass just right alongside the remainder of the companies that suffered through COVID. But that one is officially on watch right now. So at any rate, Let's go ahead and talk a little bit about the Admiral portfolio. And again, if you take those 45 names that were subject to some sort of reopening phenomenon in COVID, you get the Admiral portfolio, and you actually get a group of stocks that were more or less unstoppable during the pandemic. So this is the kind of the dream team of 30, if you will. These are the 30 companies that you can literally own and sleep at night. It doesn't even matter if the U.S. economy literally just shuts its doors. These companies will actually accelerate their earnings growth if it's obviously due to a pandemic, as we've witnessed. You can see the actuals here, this ramp up in earnings growth. You can also see that growth is tapering a little bit, and then that trajectory smooths out, and that's what we like to see with earnings stable companies. Note these same 30 stocks, how they performed through prior recessions, just absolutely incredible. In terms of the estimates, keep in mind that we've got some hyper growth phase that we're working through on some of these companies like Clorox and others that just absolutely had just tremendous earnings through COVID that have now tapering a little bit. And so we're getting a little bit of noise in F2, totally normal. F1 trajectory solid, and I expect that by the time F2 rolls into F1 after December 2021 reports, that these estimates will then start smoothing out as well. So I'm not concerned at all with what's going on in the Admiral portfolio. I've seen this before. It's very, very normal. Okay. We've had some tremendous performance out of the macro tilt portfolio. But before we jump into that, let's go ahead and take a look at what's going on with the dividend portfolio. And again, just note the growth rates, 9, 6, 10%. These are going to smooth out. Keep in mind that if I put the valuation model up here and I look at these long-term trends, if I put a least squares trend rate up here, the Admiral over the past 25 years, and I can just verify that 25 years here, right mouse click, has literally been clocking in at 12.25 growth every single year on earnings, which is tremendous. So if we compare that to the earnings certain portfolio, help if I type the right symbol. That growth rate, long-term least squares trend rate, is roughly just shy of 12%. And now if we look at the Dividend Aristocrats portfolio, you can see that we're obviously raising that yield. So we're going to cash in a little bit of that growth rate. And that's exactly what we expected to see, about an 8.83% growth rate. Again, with that higher yield, that higher payout comes a little bit lower growth as we would expect. Okay, so nothing startling there. What I did want to remind everyone here too is if you look at the earnings certain growth, the Admiral growth relative to the S&P 500, you can see that roughly around 12% growth. If I throw the SP5M up here through those cycles, this is where the S&P 500 gets hurt. That least squares trend rate is only 7% growth. So the earnings certain portfolios and core offering you tremendous growth in earnings relative to the S&P 500, about a 50% increase. So let's move on to the tilt portfolio specifically. And this is obviously a completely different story. These are our 6 macro tilt stocks who have just absolutely tremendous earnings growth as an aggregate. You can see 42% growth, 15% growth, back to 27% growth. And you can see the trajectory of this 6 stock portfolio over time. These 6 stocks have been doing very, very well ever since interest rates have stopped going up, and that value rotation has topped just a bit. So as I mentioned in that cyclical portfolio slide previously. But EPS estimates, again, for this group, just a tremendous performing group of stocks in general here. So up 38% even from the July 2020 lows, if you will, 22.25 all the way up to 30.75 now. So this group continuing to perform as we expect. So that's pretty much it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or you're interested in upgrading your current subscription, Please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you for watching, and I'll talk to you next week.